second. I'm happy to introduce Heather Fund to this webinar and Miss Kendi Kamwambia. She has over 5 years of experience in the financial management and has been responsible for managing Heather Fund's business investment portfolio, facility, uh, facility to ensure recovery of distribute funds for recapitalization of, okay, let me just mute. Please remember to mute your mics. Going back, she is responsible for managing Heather Fund's business investment portfolio, facility to ensure recovery of dispersed funds for recapitalization in the subsequent call for investment. She also identifies investees' capacity building needs and assists in the sourcing of consultants to close the gaps. Kendi is an ACCA affiliate and has a bachelor degree in finance and accounting from Strathmore University and is currently pursuing a master's degree in monitoring and evaluation for Nairobi University. Kendi, I pass it over to you, and thank you for being with us today and sharing some light on how we can become investment ready.
Charge of supporting compliance. And just to give you a brief background on HIVA.
Sorry, Kendi, can you just start again? I had to unmute you.
All right.
All right. Sorry. Go ahead.
Hello, everyone, from wherever you're joining us. Good morning, good afternoon, good evening. My name is Kendi Kamwambia, as you've been told by Letitia, and I'm in charge of the support and compliance department at HIVA Fund. And just to give you a brief history of how HIVA Fund was started and what our mandate is, well, HIVA Fund was founded by its parent company, the Nest, and the Nest is it's an organization, a collective of artists who, through their day-to-day activities and their day-to-day like works as artists, recognize the challenge of finance, the challenge of skills and capacity building for artists. And so they formed a separate company, HIVA, to address both financial needs, capacity building needs, and research for the creative sector in Kenya. So HIVA we have a three-tier mandate. The first is capitalization, financial support. We do direct investments in form of both loans, convertible loans. We have a mixture of some grant components in our financial support. We also have capacity building arm where we do workshops and skills training and just equipping the creative sector to be able to function in a more professional manner. And then our third arm is research, because we understand that in order to make a case for the creative industries, we need sufficient data on the sector so that we can even influence the government to legislate in a favorable manner towards the creative enterprises. And so I'll take you through becoming investor ready, the webinar for today. So for you to be investor ready, there are a couple of things or checklists that we'll go through in today's webinar, and they will be able to enable you to determine whether you're investor ready at the moment or what you need to do to become investor ready. And so at the point where you're looking for investment, there could be several scenarios. It's either you've grown to a point where you need additional funding, and that funding has to come from external partners. You can't achieve the next phase of growth out of your own pocket, out of your own retained earnings, and so you want to access the next level of financing, and so you go into the market to look for financing. Or it could be that you have an idea, a pre-seed idea, and you just want the first initial investment into your business.
Hi, Kendi. Remember, you can change the slides.
Yes. I'm just
Okay.
giving a brief
All right.
background to
All
them.
right.
Yeah.
Thank you.
So with these two scenarios, there are a couple of things that you need. But what we've learned in the 5 years we've been in operations as Hiva is that we need the business owner to match risk as well. So you want to invest in a business where the owner has already gotten to the past proof. Proof of concept has been done by the business owner, and so you're investing in a post-revenue business. And so I'll take you through the slides, how to become investor ready. And so, sorry. And so at the point where you realize you need injection of funds into your business, you need to determine what's the best avenue or what's the best channel for you for investment. Do you prefer debt where you want to, or do you prefer equity? There are pros and cons of both of either investment, and it depends with you personally as the business owner, as a proprietor, what works best for you. Do you want to give out control in terms of equity and shares, or do you prefer to retain the control, and so your most favorable avenue of financing is debt? Well, there's also a third option, grants, which are quite rare for business cases. But if your business has a social impact aspect, then you can be able to access grant financing. But these are quite rare, and the most common forms of investments are debt or equity. And so moving on to the next slide, on identifying your ideal investor. So there are various funds, there are various venture capitalists all across the world, and they have different policies and procedures for the investment. Some only invest in business that have revenues over 100, let's say $100 million. Some are intermediate, where they invest in businesses that are $50 million and above. For us, we categorize our pre-seed ask as companies that require about, I'm trying to translate from Kenya shillings to USD, that's $5,000 are pre-seed, and then seed we have $10,000 to about $20,000, and then growth phase we have 50,000 to 100,000, or even 150 or 20,000 for the growth phase. So you need to know uh, the ideal investor that you've identified, what phase or what does their portfolio look like, and so you align that with your business. So if your business is still in a growth phase, if you look at this business revenue cycle, if it's still a startup and you're in the pre-seed business, you need to focus on the investors who deal with startups and pre-seed kind of financing. And if your business is in the growth phase, then you also align that with the investor. And so if you look at this business revenue cycle, your business could be in the decline. And there are some investors who are known to invest in companies that, let's say their market price is falling, and then they're able to turn around through strategies, and they're able to introduce new products, new markets, and the curve, and the business is able to pick up and demonstrate growth. So you need to know what phase of the business life cycle you're in. Are you in pre-growth, growth? Are you just sustainable? And or are you in decline, and which investor would be ideal for you? And then once you identify the ideal investor, you check that against what is their investment policies. Do they still invest in the level of growth that your business is in? All right. The next is the pros and cons of sources of financing. We did talk about debt and equity and grants earlier on, and this is for you to know the most ideal source of financing for you. It depends really with your aspirations for the business, also your personality as well. Do you want to give up control of your business? Do you want to retain control? Because debt allows you to retain control. Debt allows you to have a tax advantage because once you charge the tax expense on your revenues and your earnings, then the amount that's left for once you sorry, let me repeat this again. So once you charge your interest expense on your company's revenues, then the profit left for taxation is much less, and you're able to save on the tax aspect. Also, debt has easier planning because from the beginning of the debt contract, you know how much you need to pay in terms of installments every month or every quarter. You know how much of the principal you need to pay, how much of the interest you need to pay. But also there are some cons to debt, which are like qualification requirements. Some people require you to have collateral. A lot of financial discipline is needed because once the payment is due, the payment is due. And if you don't meet your payment, then you run into trouble. And then the next source of finance is equity. There are pros and cons to it. The con being that you have to give up ownership. So you have to take someone else's into consideration when you're making decisions, and you don't like own the business wholly by yourself, and so you have to bounce back ideas on the other owner to the business. And so if you like control, then this is not the option for you. And equity has some pros where there are no interest payments. So if you don't make any profits at the end of the year, then you and your partner walk away without any liability to each other. And so also equity has no personal liability and there are no monthly payments, but also you have to give up ownership. So you have to weigh what works for you and go with that. There is a third option for grants, but we did say that these are quite rare and are only mostly accorded to businesses that have a social impact in the community. And these are grants, and the pros is that they're generous sums, they are easy to repeat success because once you've gotten a grant from an organization, it's very easy to get another grant from another organization. You build credibility as you go. And so grants also build visibility and credibility, but the cons on the other side is that they're quite time consuming, but so is also writing debt proposals as well, or equity. They're quite time consuming, but grants are way more time consuming because the due diligence and compliance is quite something. And so they require specific skills. So you'll require a grant writer. Also, debt requires specific skills. You'll need a financial modeler, someone who can model your finances and see whether you're able to carry what level of debt exactly. And so grants are also highly competitive with low success rates, and there are strings attached. Yes, with grants there are deliverables that you have to give to the grantor for them to be able to give the grant or for you to comply with the grant requirements. So you just analyze these three sources of financing and see what works for you and your business, and then identify the investor who operates in such an environment. So the ideal investor, we had touched on this a bit when we talked about what phase of the business your ideal investor normally invests in. The next is the sector. So some funds, some VC funds, some even let's say non-governmental organizations that give grant have specific areas. It might be agriculture, tech, fashion. So you need to know your ideal investor, what sector exactly that they do invest in, and whether you are aligned. And then the other thing about identifying your ideal investor is how active do you want them to be in your business. You can have an active or a passive investor. And so this is according to your preference. And you can identify the investors who pump the funds into the business and then walk away and wait for the time period for their returns. These are like mutual funds or pension funds, kind of VC arrangements. But there are some investors, if you approach a mogul who has funds to invest in personal business or individual businesses, then they might be more active when you compare to the institutional venture capitalist kind of arrangement. So you have to decide that as well, how interested you want them to be. The other thing about having an active investor is you have to see who aligns with your business. Say you started a business and you have all the capacities inbuilt, but you lack marketing and distribution expertise. And so you find a venture capitalist company that has a strong focus on, let's say, marketing, and those would not only bring finance or financial help into your business, will also bring marketing expertise and will enable your business to scale, not only from the financial help, but also from the extra expertise, let's say in financial or in HR or in other aspects of business. And then with a grant, you have to analyze whether your interests are aligned with the investor interest. So we say that for you to access grants, you must have a social impact focus. Let's say if it's women empowerment, then you'll want to align with grantors who are focused on the women empowerment value chain, to say. Moving on. The first thing that you must demonstrate to your investor is the team who runs your company. It's very risky for an investor to invest in a one-man team, because that means then if the individual is not in the right business mood, then business doesn't continue. If the proprietor is sick, then business doesn't continue. So it's it's always it's the most ideal situation to invest in a company that has a management structure, and a management structure that brings several different aspects of expertise into the business. So you need to have a team, and a team with qualified experts in different arms of the business, be it HR, be it financial management, be it marketing. You have to demonstrate a team, a very capable team. The next thing is the product. So you need to demonstrate to the investor what the value proposition of your product is. And so in this aspect, you have to demonstrate what gap does your product or service offer to the market, and what does the evolution of the product look like in the future, because we know with IT and with the way things move really quickly, business have to be innovating and have to keep up with change. So you have to have an outlook of what the product evolves into. Is it new markets? Is it new products? Is it different price points? Will you try and access different markets given the different from the angle of different price points? So this is something that you need to demonstrate and have ready before approaching your ideal investor. The next aspect is the market. You need to know who your target market are. You need to know what their consumer behaviors are. Do they buy on a seasonal pattern? Is it end month that you have the highest sales? Is it certain seasons or certain quarters of the year? Are they price sensitive or quality sensitive? Do they, if you change your price by, say, 10 points, do they mind that? Or are they focused on quality? As long as they're getting quality product, and this is mostly for luxury brands, people are not price sensitive on that. And the other thing that you need to know before approaching your ideal investor is what other complementary goods or services you could sell to go with your main good or service, because this is an avenue of expansion for your business as well. So this is another thing that you need to know before approaching your ideal investor: who your target market are, and what are their consumer behaviors, and how you've analyzed that as well. Then the next thing is still in the market. Um, you need to demonstrate to your ideal investor what percentage of the market you have, what percent of the market share you have, whether you're the highest market shareholder or the least market shareholder. And if you look at this diagram right here, um, it analyzes a product's market share position given the level of investment it would take for the market growth rate for that business. Let me just explain that. So if you look at the dogs, the market share is low, and it's using there's low growth rate, uh, and the cash usage to attain that growth rate is still low. So products that are dogs are, they can either be introduced into a new market or just let go, because there's no growth here. There's no market growth, and there is no market share growth. You're not going to get more from your competitors. The next aspect of a product could be a cash cow, where the market share is high and the market growth rate is low, meaning that everyone in that market has their own niche clients, and everyone is working at optimum in terms of market growth. So there's no further market growth. The market is saturated, so there's no cash usage in terms of marketing, advertising. That's low as well. But you as the product, you have the highest market share. So you're the winners of this race, this market share race. So that's a cash cow. It doesn't spend much money in advertising, but you still have the highest market share. The next is stars, where the growth rate is high. So here people have not reached the optimum of the other companies competing with them have not reached optimum. There is still some growth left, and the growth is high, and you still have the highest market share. So you're leading in the market share, and these are stars. They perform really well. The next aspect of a product is whether it's a question mark. You need to ask whether your product is a question mark, where the growth rate is high, but your market share is low. So you're the one coming in last in this competition, yet you're using so much money in terms of advertisement to access this growth rate that's still available, but you're not able to access. So it's a question mark, because you ask yourself, should you continue spending more money in advertising to increase your market share, or should you just let it translate into a dog and lose that market share and stop using the cash and just lay off that avenue of the business, that product? So this is a very important thing that your investor would want to know: where does your product fall in this market share analysis? The other thing is, we've kind of talked about it, your key competitors in their share of the market, and the cost implications for you to maintain your market share. That's what I was talking about. That's what I was talking about on the growth rate, about the low or high growth rate, which means if it's low, then everyone is operating at minimum. All your competitors are operating at minimum. Everyone has their loyal clients. There's no need to spend money advertising, because you've all reached an optimum. But if the growth rate is high, then there's still a market to be accessed, and it's a question of, do you invest more in advertising? Do you invest more in distribution to be able to achieve a higher market share? Great. So The other thing that you need to have before approaching your ideal investor, or to ensure that you're ready to approach your ideal investor, is a financial outlook. So you need to know the cost per unit of your production. This should be at your fingertips, really, because as an investor, I want to know that the person that I'm investing in understands their business through and through, from the beginning to the end. They know exactly how much ingredient, how much input goes into a unit of production, and they're able to know the cost implications of even adding an extra ingredient or adding an extra unit. So understanding the cost per unit of production is very important, and it should be on your fingertips as a proprietor of a business. That just builds confidence in the investor to know that they're investing in someone who knows what they're doing and understands their business through and through. The other aspect of the financials that should be at your fingertips is the gross and net profit per sale. So you should know how much of gross profit you make from a unit of sale. The gross profit is the profit before you take out the operational cost. Gross profit is just a profit you get just from removing factors of production in a unit, and then you have to charge the operational costs. These are the rent, the utilities, to get the net profit. And so you need to know both these figures. So where this comes in is that if your gross profit is 50, but your net profit is 10, then there's a problem with the control of your operational expenses. And this is something that the investor would want to know before they invest in a business, whether the overheads are just over the roof and eat into the profit, because a gross profit of 50 should then translate into a net profit of about at least 25 and above. Yeah, the next aspect of financials is annual net profits. And so this is a very important aspect for both debt and equity, because this is the amount that remains uh, once you've charged your taxes, you've charged your expenses. These are the actual profits from where the equity investor gets paid from. So they want to know, what do the dividends look like this year? And this is determined by the annual net profit. Also for debt, they need to for debt investors, they're very curious on annual profits as well, because a low annual profit pre-investment, pre-debt injection, means that the company will not be able to carry an extra expense of the debt, the interest expense. And so annual profits is very important. Check on this, see whether your net profits are healthy enough to carry a debt facility, and whether they're healthy enough to entice an equity investor into investing, because of the attractiveness of dividends that they are promised at the end of the year. Then the other thing on financials is any pre-existing debt or preferential shares.
Hi, Candy.
Yes.
Just before you begin, I kindly ask for everyone to mute their mics. Candy, if you can go to the right-hand side and select anyone, and if you select the right button, just mute all, that would be great, because there's some noise in the background.
And
Just mute all. If everyone could please mute their mic, that would be great. And you can continue. Thank you.
I'm saying
Hi,
zero
can
because I need to mute
can
myself.
Miss Hassan please mute your mic? Thank you.
Am I back on?
Yes, you are. Thank you.
Okay. So the financials is the reason why it's important, especially when the investor is analyzing the balance sheet. They want to know whether there is any pre-existing preferential debt to theirs for a debt investor, and for an equity investor, they need to know whether there is any preferential shares to theirs. And preferential, I mean, these are the people who, should the business go into liquidation or run into troubles, So the people who get paid first after the creditors. And so that means if there's any existing such kind of an arrangement, then a new investor coming in would want to either increase their interest or increase the level of like if it's equity, then they'll want to get more shares for a lesser amount because they need to balance their risks. Because preferential shares do pose a higher risk for an incoming uh, either debt investor or equity investor because it means then there's someone who has first dibs on the business before them, and so this is risky for them, and they need to analyze that and like it needs to reflect the risk aspect of that needs to reflect either in the interest rates or reflect on them acquiring more shares for a lesser amount. The next aspect is financial projections and milestones. So you need to prepare projections. This would be you prepare an outlook of once the funds come in, what does the revenue look like? What does the growth for the next 5 years look like with the funds injection? So that the investor can see what their investment translates to, what kind of growth does the investment bring, so that they can be able to be assured that they're not losing money if everything holds constant and your projections actually materialize, then they're able to see before even investing that it's a worthy investment. And then the other aspect of milestones is you need to have a list per se of the milestones that you want the business to achieve. You want maybe in the next 2 years you want to have a market share of a certain percentage, or you want to grow regionally, you want to move out of your current region, or you want your marketing to have a certain to operate at a certain level, or your profitability, or do you want your HR goals? These are just goals. So maybe you want to have employed 10,000 people by the end of the year. So it's important to have these milestones documented, also for tracking and assessing your growth or your impact with the business. The next aspect that you need to prepare for is valuation. So it's important to know the value of your business, especially if you're going to be looking for an equity investor, because once you're aware of what the value of the business is, then you're able to know that for this level of investment, the equity investor gets this amount of shares and control. With debt, it's also important to know the valuation of the business in terms of the debt to asset ratio, because a lower debt to asset ratio reduces financial risk because it means you have enough assets to cover your debts maybe 2 times over or more. And so a debt investor would feel more secure that in case of liquidation, in case things go sour, then your assets will be able to repay his debt. Uh, and still on the valuation bit, there are several methods to use when valuing a company. You can use a cost approach, which is generally valuing your company at the cost that it's taken to build. And so here you'll include even the goodwill, you'll include all the assets that you've bought, all your balance sheet items. Generally, it's just the cost is taken, both financial costs, like the actual money that you've paid for your assets, and also like goodwill, the not unquantifiable, but it's a bit abstract. It's an abstract value, but it's very important when you're valuing your company because it's taken more than financial input for your business to be where it is at the moment, and so that has to be quantified. And if you're giving someone shares, they have to pay for that as well to get in order for them to get a control of your business. The other aspect is a market approach, where you compare with the companies that have gone public in your sector. Say, um, in the past year, there was a fashion label that sold for a ballpark figure of 20 million, and their earnings were 2 million per year. That means that company was quoted 10 times its earnings. So if your earning is 1 million per year, then your value is 10 million. I hope you got that. So you just compare with the sales of companies that are in the same sector, and what is used mostly is the PE ratio. The other method of valuing your company is the discounted factor method, where you forecast for future revenues, bring them to the present, and determine the value of your business at the present based on the future revenues you anticipate your company to earn. But you can always get this done by financial professionals. You can get someone to do a valuation for your business so that before you approach your ideal investor, you are aware what the value of your business is, so that you don't undersell or you don't oversell and lose the investment. The next aspect before approaching your ideal investor is that you need to have a pitch deck. There are various forms of pitch deck templates, but ideally, all you should have, or the main things that should be reflected on it, are the history. One is the history of the business. How did you start? How did you come about this idea? What has the journey been like? Just it can be a short video. Also, you don't want to bore the investor, or sometimes you're given a really restricted amount of time to pitch, and so it can be a short 2-minute video of the history of the business from where you started to where you are now. The next thing is you have to have your product, which is your product summary, what your product does exactly, what your revenue model is. By this I mean, if your cost is say 50, you mark up by 20 shillings. So that's your revenue model, that you always mark up by say 10% or 20% of the cost, or 50% of the cost. And we've touched on this a bit earlier. The other thing you need to have in a pitch deck to go is a sales, marketing, and distribution avenue. How do you do it? How do you distribute? How does your product get to its final consumer? The other thing you need to have, we've touched on all this actually. I'm just summarizing what you need to have in a pitch deck template. And competitor analysis is one of them, and what your advantage over them is. The other thing is financial projections, and because you can't, it's difficult when you're pitching to come with Excel files and Excel files of income statement, balance sheet, what. So just have a snapshot. Um, I mostly what I've seen working with us is people come with graphical representation or tabular representation of the profits. So you're able to see, let's say for the 2015, the profit was at this level. In 2016, it went up by this. So you just come with a bar graph or a line graph, and those graphical representations are very easy even for the investor to grasp, and they remain in their head longer once they go back to their committees and everything. They're able to analyze, they're able to remember how your growth projections were, how your growth performance has been over the years. The other thing is team. We talked about it earlier. Just mention who your core team members are and their expertise, and definitely the funding, ask how much you're asking for. It's also important to have a due diligence, uh, due diligence requirements ready to go before you even approach your ideal investor. And so with due diligence, the investor wants to know who actually owns this business. This is the legal aspect of the business. He wants to know how has the business been performing financially, and this is represented by the audits. He wants to know the latest management reports. The reason why management reports are also important is because audits are given annually. So say you're pitching or you're approaching your ideal investor in September of 2019, but your last audit is last year, 2018, December. So it's important for the investor to have the management reports for the last quarter, say July, August, September of 2019, so that they're able to know the current performance of the business. It's more immediate, it's more reflective of the business performance. And then the other aspect is the HR organogram, where they need to know who is the team, what are their expertise, and what are they getting themselves into. Because investment is a long-term relationship, really. Whether it's equity or debt or grant, there's a specified number of years, unless you're doing a short-term investment like an LPO financing or something like that. Most of them are long-term, and so there's a lot of personal and interpersonal relationships that have to be established, and trust that has to be established for an investor to feel comfortable to put their money into your business. And so the other thing that you must have figured out before you approach your investor is the exit strategy. What are you selling them, really? Because investors come into a business for a short while. They make their money, they use that money to invest in other opportunities because there's an opportunity cost there, and they have to also feel like they have the option to exit whenever they feel like the business isn't going the right direction, or they have achieved their requirements, they've achieved their goals, they've made their 20% markup on the investment, then it's time for them to move on to another investment. So you have to show the exit strategy beforehand, before while you're approaching your ideal investor. So for debt, it's very easy. The exit strategy is the end of the term loan. If you give me a 5-year loan, at the end of the 5 years, you've repaid my principal and interest. We are done. As an investor, I exit peacefully. For equity, there are various channels to exiting. You could have an initial public offer where now you stop being a private business and you go public, and then the investor is able to and then the initial investor is able to sell his shares to the public and exit in that channel. The next is management buyout, where you as the business owner, you could have an agreement with the investor once they're coming in, that in 5 years time you will buy back your shares at a certain rate, definitely way higher than what you sold them what you sold to them at the beginning. And then the other one is an acquisition. You could get acquired by your competitor or a bigger competitor, and both you and the investor exit the company. So it's very important, even beforehand, to choose or to be settled or to be aligned, both you and your investor and your management team and your co-owners, on the exit strategy of the business beforehand. So once you're settled on this, then you're able to approach an investor and be like, this is our growth, this is our journey, but once we get to this point, this is how we are all exiting, or this is how you will exit. So this is very important as well. So the other aspect is that you should know exactly what your ask is. We've had people come in and they need money, yes, for the business growth, but they don't know exactly what their needs are. And so you have to be very clear that I need $5 million. $1 million is capital investment. I need equipment. 2 million is working capital. This other amount is to build my HR capacity. You need to know exactly what your funding ask is, and be conservative. Don't ask for more money, especially if it's debt. Don't ask for more money than you need, because this is the liability that you're putting on yourself. And so you need to know exactly what the funds will be used for. I think that's it for my presentation. And with this funding ask, you need to have a budget. So it's good to have a budget on, I need 5 million, and this is how I'll break down this 5 million ask. Yeah.
Perfect. Thank you so much, Candy. Everyone, I hope you enjoyed the webinar. We were going to have about 10 minutes of questions and answers. So please do use your chat box to ask these questions, and Candy then will be answering. So I think this is a great opportunity now to ask from an expert. So please use the chat box. So can you just answer my first question? Um, in your opinion, which would be the best financial instrument to use? Would that be debt or equity? And at what phase should you consider equity?
Okay. I talked on this a bit earlier. I'd say that there is no ideal investment to really for a business. It depends with what a business needs at the moment and what the proprietor feels works for the business. But there are pros and cons to each, and debt is actually cheaper than equity because you have tax advantages. You know exactly how much you're paying at each month or at each interval of repayment. It's much more predictable, but also it comes with an added liability of you must make the payments each month for you not to contravene your contract. So there's no ideal vehicle of investment. It's just what works for you at that moment. And with equity, you had asked about equity. Um, Equity has less liability. That if you don't make profits, then both you and the person who's invested in your business, if you don't make money, then no one makes money, and no one has a liability to the other.
Mm,
But it's expensive if you make profits because uh, if you agreed on how you will share the dividends, there's no tax advantage to that. That's exactly how you'll pay. The agreement is how you'll pay out your dividends, and so there's no actually ideal like investment vehicle. It's just what works at what time and for the person and for the business.
excellent. We have a question from Miss Ashwini. She asks, is there a module framework which could be created mathematically to derive a solution for making a choice for selecting the type of funding methodology, whether debt or equity or grants methodology selection?
There is a module that there's a cost analysis that you could do for both. Um, Mostly it's done during the financial modeling phase. When you're doing your financial modeling, once let's say your conversation with the investors has progressed to the level of financial modeling, there is a formula to determine what's the cost implication of debt and what's the cost implication of equity. Although with equity can be definitive because it's dependent on the business performance, but you can lock in the expected performance and calculate the cost of that based on that, and you can be able to analyze the two. But it's known ideally that debt is cheaper because it comes with tax advantage than equity, but also the liability of repayment is quite a hassle.
Okay.
Yes, so there's a module, but it's not a template. It's very business specific, and so you have to lock in performance, like the anticipated performance of each business, and you have to lock in the interest rates of your what your creditor is giving you, the loan at what interest rate. You have to lock that in.
Thank you. We
Yeah.
also have a question from Miss Amma. She asks, what about angel investors? What's your experience in Africa with African angels? How do you approach them and how do you get introductions? Is there any way you can find out who the investors in the African digital publishing space are?
All right. I'll start. start with the last question that you asked. I'm not sure who the investors are in the digital space in Africa. I'd have to find that out and get back to you. But on angel investing, we have it's called VBAN. It stands for Victoria. Let me just confirm that. Angel Networks. Oh no. Hello? Can you hear me?
Yes, perfectly.
Okay. It's called VBAN, and I'm trying to find out what it stands for. Just a second. Victoria Business Angel Networks. So yes, they do exist, angel networks, and with angel investors, every deal is structured differently. There's no template for angel investing. It's what you and your angel investor agree on, and they do exist in Africa. That's one of them, and they have networks to others. I'd have to do an introduction if she was interested in pursuing that avenue of investment.
Thank
Thank
you.
you. Thank
And
you.
there is another question from Miss Alina.
Mm-hmm.
She thanks us. Thank you, Alina. Um, and she's from Ukraine. She's asking, could you give any tips on
Mm-hmm.
how to pitch when you present your project or business to an investor in person?
In person. All right. So this depends. Is it in a pitch session setting, or did you just corner your investor, let's say in an elevator, and you have to do like an elevator quick pitch?
Also, just to add to that, Miss Alina, we actually will have a webinar on pitching to investors. If
Yeah.
I'm not mistaken, Candy, that is your colleague as well that's going to.
Actually, it will be me who will do the
I,
pitch investing
all
one
right,
way.
it's going to be
Yeah.
you. So maybe you can give a
I can
brief.
just run down. Yeah.
Yeah,
All right. So to get your investor hooked, all investors want to make money. Show them the dream. Quote the dream in terms of figures. Tell them if you give me 5 million and you've crunched these numbers. That's why I said like before you approach your investor, you need to know what your ask is. You need to have financial projections that once this one come in, my revenue grows by this amount, my net profit grows by this amount. So you tell the investor the first sentence once you get a chance with them after high is if you give me 5 million, I will make you 10 because I anticipate that my business will grow 2 times over and you will make your money 2 times over. So the first aspect is show them the dream. This is what you're investing in. Oh no. Hello?
we can hear
Hello?
you.
Oh, sorry, I got disconnected.
No, 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 we can hear you perfectly.
Okay. Yeah,
Show
so
them the
sell
dream.
them the dream. That's the first aspect. Show them where the money is. Then you're sure to get a second, let's say if it was an elevator pitch, you're sure to get a sit down meeting with them. And this is where you will show them what your marketing distribution looks like. You will show them the competencies of your team. You will show them your competitor advantage over your competitors. And but the first thing to get them hooked is show them where the money is.
Excellent.
Yeah.
Then we also have a question from, give me a second, from Miss Pretty. She asks, in grants, why do we need to have specialized writing skills? You mentioned this on the slide.
Yes. Well, grant proposals are very specific. If you're writing a grant proposal for agriculture, it's very different from someone writing a grant proposal for tech. And with debt, a bank, you approach a financial institution and say, here's my collateral, here are the requirements you wanted. But with grants, you have to comply with so many things. You have to comply with anti-terrorism, anti-money laundering policies for the donors. You have to, there is so much that you have to comply with, and you have to put in the proposal that you need specialized skills unless you have them or you train yourself or you've gotten the training from online platforms like YouTube, or you Googled, or you've attended a webinar, or you've gotten some online class, it's possible that you can write for yourself, but they're more personalized, they're more time consuming, they demand more. Grant proposals demand more than a debt proposal, because a debt proposal, as long as you have the collateral, you have the requirements of the institution, and you're qualified for the loan, you get the loan. But with grant proposals, someone could be, well, there could be a different aspect that they cater for. Let's say, for instance, if you're competing for a grant with someone else, they could choose theirs if it has more impact than yours. So there's more nitty-gritties and nuances to grant writing. And so it might need specialized skills, but you can do it yourself. It depends with where the grant proposal is going to, and your level of understanding of what the grantors' requirements are. Because if you like, for me, if I had to write a grant proposal, I'll need help on anti-money laundering. I'll need help on anti-terrorism aspects in the proposal as well.
Thank you, Candy. And we have another question from Miss Olume Isi. Sorry if I pronounced it incorrectly. She's asking if you have been a sole proprietor for a long time and was making profit, but due to unforeseen circumstances, business starts to crash. What is the best way to bring it back up, especially when you uh, if you don't have easy access to funds?
Okay. So when a business is in decline, there are various strategies to revive that business. But the first point where you start from, where you start the reviving from, is understanding why the business failed in the first place. Is it you're not making enough sales, or are your costs too much that regardless of whatever sales you make, there's no way to break even or make profits? So if it's that you're not making enough sales, you need to determine what the market looks like. Is it that that item has either gone off market, like it's become obsolete, or is it that the market has like there's an economic term and you can't afford your thing or your product anymore? So you need to understand the reason. And if it's market, then you have to find a new market or find a new product that still serves the market, either the same price point or serves a different market, that who, if it's an economic downturn, they're still able to afford your product. So you serve the next or the next level market, or you find another market completely. It could be regional. If it's West Africa and your product isn't selling, let's say you're selling printed fabric and the market there isn't responding, either because of economic downturn, then you move to the East African market. So, or you find a new product to sell. You stop selling fabric, you start selling food, because people need food regardless of the economic situation. So you need to understand the reason why it failed and find new avenues of growth, either by new product or new market, if it's a marketing thing. If it's a cost thing, that your costs are too high, that you can't break even, then you need to analyze your cost cut in any way possible, but still like within the legal limit. Like, don't pay people pennies or pay your wages like terribly, your wage staff terribly. Yeah, that's
Uh,
what I'd say.
Excellent. And Candy, just one question from my side. Maybe this is for some women who also are in Olimisi's situation. We'd also just like to know, is it better if she registers her company? Um, and do impact investors invest in proprietor? Um,
Mm,
so that is something also I'd like to know. And for everyone else, we're going to be taking the last few questions, so maybe the last three questions, and then we're going to wrap up.
okay. So It depends the jurisdiction. So some countries it's easy to set up companies, and in some others it's really a difficult process. And so companies are the best way to operate because it also limits your liability. No one will come for your car, no one will come for your cooker in your house if the business fails and you had debt or you owed creditors or you owed a bank or a financial institution. So a company creates a separate legal entity and you're protected in that way. Also, to be able to access different levels of funding or good dealing with companies than they are dealing with individuals. So once you're incorporated, you're able to access even bigger clients, you're able to access better debt or better debt terms. You're able to access grants
Mm.
because it's a legal entity on its own, and people feel secure dealing with companies. So I'd advise if the jurisdiction is it's not too tasking or it's not too, or even if it's crazy, just go through the process. It will be a worthy investment.
Excellent. Now we have a question uh, from Miss Bosan. She says that she has an agribusiness. It's just 2 years old, and she has put infrastructure for irrigation for farmhouse, and she has the utility land, but not enough money to continue. And she's not making money yet until February 2020 because of the produce. How can she convince an investor of a potential and a high return on investments? Oh, sorry, Candy. Give me a second. You are unfortunately muted by. Okay, there we go.
Yeah.
Yes, yes, you're done. Yeah.
All right. You're saying she hasn't been making any profits like all along, or is it for this moment as she waits for the crop to grow and be ready for market?
I think at the moment, she just started her agribusiness. She has all of the infrastructions, but has not made money yet. But she looks um, to have money, but she would like to convince an investor that there's potential in her agribusiness.
Hmm. Okay. So I think for this for agribusiness, it's always tricky because um, an investor would only get paid if the crop succeeds and if it makes it to the market and it gets a market in the first place. So it might be difficult to convince an investor at the moment, and she might need to build a track record of her farm, of her business, say for 2 years or 3 years. Then she's able to show that for me, every time I farm, my output is this much. I always get it to market and I always get a market, and this is how much I make. So once she's able to prove a track record, because also you don't want an investor to just come, there's no investor who will come blindly and be like, oh, I see you have a business. We haven't proved whether it works yet, so here's 10 billion, just experiment with it. No, they are really averse to that. We are also really averse to that. So she has to build a track record for 2 years or more, and then she's able to demonstrate the success of this business, and then she will be able to convince either a debt investor or an equity investor.
Excellent.
Yeah.
Uh, Let me just see if there are any other great presentation.
But in the meantime, just to add on, if she needed funds really urgently, let's say to buy fertilizer or just for further input, she could do a short-term debt facility where she approaches the an investor and says, I don't want a long-term debt. Just give me this much money. I buy my working capital. So like an LPO financing
Mm.
arrangement. If she can be able to go to the market and get a supplier or a distributor to give her an invoice for her produce in a year's time, then she can use that invoice to get financing, in like invoice discounting or an LPO financing kind of arrangement. She can be able to get the funds now with promise
Yes.
that once the product is ready, it will have an immediate buyer who has already issued an LPO.
Perfect. And we have
Yeah.
one last question from Miss Amma, and she says, if you give up equity in a pre-seed or seed round, what happens to that equity in the next round? Is it advisable to give up more than, say, 30% in a seed round?
Hmm. Okay. So once you give out equity, let's say in a pre-seed or seed round, and you're trying to access the next round, the person you gave the seed, you gave the stake to, has to be in line with your goal. You have to sit down and agree. Does he still want to continue in the business? Say for instance, uh, during the seed phase, you gave this investor 20%, so you still retained 80%. When you're trying to access the next level, you will decide, does he want to relinquish 10% and still continue with 10%? Does he want to relinquish completely, or does he want to retain his 20%? Then it's up to you to reduce your 80% and give the new investor in the next phase, or does he want to still be the investor in the next phase and top up the value of his stake at the moment? Yeah. And then there was a second part of that question. I'm trying to remember.
Give
Leticia,
me a
kindly
second.
help.
Should you give up more than 30%
Should you
in
give
a
up more
seed
than
round?
Oh, there,
30%?
there you go.
Yeah. Well, it depends. I always say you don't need to give out full control of your business. Surely you can retain 51%. The 49 is it's open for business. If someone is bringing in good money and they only want 49% of the stake, which means you retain the control of your business, then be it's still a good business decision. It's still a good business arrangement as long as you maintain control. It's just how much are they bringing, and is it worth your business or your time?
Perfect. One last question, and I think it's a big one. It's where can we get an LPO financing?
LPOs financing are there are various, like for us in Kenya, there are various institutions that give them. Banks give them, savings and credit unions give them. Um, who are the other people who give? Like institutions like HIVA do give LPO financing. So you just have to determine in your locality who is open to such an arrangement. But banks are always open to them. Several financial institutions as well.
Excellent.
And I don't know, for us here in Kenya, there's a huge penetration of overnight mobile lending, and that's one form of LPO financing. If you just need, say, five, okay, they don't give that much money. They just give up to, is it $200? 200 to $500. That's the maximum you can get. But
Uh,
it's overnight lending is also available from
Overnight
most
lending.
parts of the continent, Africa.
Perfect.
Yeah.
All right, everyone, thank you so much for tuning into this webinar. And we will be having more of these investment readiness webinars. And this is more for the SheTrades Invest uh, project, which we want to make sure that our women are investment ready. The next webinar will be on the different types of investments available. You will get more information on the next webinar, and it's going to be due on the 23rd of August. And again, Have a Fund is going to come and empower us a bit more on investment readiness. And Candy, thank you so much for taking the time and giving us such valuable information. Is there any last words from your end?
Thank you so much, guys. Thank you, Leticia and SheTrades, for this opportunity. Thanks to all the amazing ladies who've joined us today. This has been a really great session. I can't wait to meet with you guys for the next one.
Perfect. Everyone, just final words. We will be sending out the evaluation link. If you could please fill this out, it's really valuable to us for us to understand what are your needs, how we can improve, and what other sessions we can get. Once we get the evaluation form, we will be sending out the PDF version of the PowerPoint presentation and the link to the webinar. So on my side, Leticia Johnson, thank you so much everyone for participating, and we'll see you on the 23rd of August to understand the different types of investment available. And enjoy the rest of your day, everyone. Thank you so much.
Thank
Ciao.
you. Ciao.